why do I continuously choose and talk about QuickBooks Desktop as the solution for QuickBooks inventory clients? Is because just by going to QuickBooks Pro in compared to QuickBooks Online, these are all the things that you get that are different. The average cost. Now, some clients want that, but I'm in the fence whether I like average cost or not, and I've been using it for so long that I don't mind it anymore. Most people like FIFO, but so with QuickBooks Pro, you get average cost. Add edit multiple items is incredible for batch editing and importing items, which is crucial when you have a lot of items. With QuickBooks Online, I hate the fact that it takes so long to update pricing and stuff like that. Item groups. So if you sell tires, you can sell a package or a kit of 4 tires or something like that. That's a great thing about groups, is it's grouping them together. Subtotaling, like some clients want car parts grouped, and then the boat parts grouped, and then the airplane parts grouped, or whatever. So sometimes the subtotaling really helps organize your invoicing and your uh, and your estimates and your sales orders. So I think subtotals are so important, and QuickBooks Online doesn't have that. Progress invoicing. Sometimes we plan to have a client plans to buy a whole bunch of product, but wants you to ship it in pieces. And then progress invoicing actually helps with that. Progress invoicing is typically more for construction and projects type of stuff, but for that in particular, it could be useful for inventory. Item receipts as a separate workflow of receiving a bill. That to me is huge. Also, a lot of clients like to receive the items as one transaction, and then come back and convert them into bills as a separate transaction. So you get that with QuickBooks Pro. You get partial receiving of purchase orders. You get up to 5 item level custom fields, and hopefully, if I don't know how much time I'll have today, I'll be able to cover why that's so important. Item profitability and inventory stock status reports. You don't get that in QBO. You get that in QuickBooks Pro. Fixed percentage price levels, very useful for giving somebody 10%, 20%, depending on the situation. Recording minimum reorder points is huge and crucial for planning inventory purchasing, and being able to add another item name like the manufacturer's part number on POs, to me is a really big slide. So now let's talk about moving on to QuickBooks Premier. And honestly, QuickBooks Premier to me is the baseline, right? So if you are going to have a client with QuickBooks inventory, you're either going to use some sort of third-party app with QBO, um, or or you're going to have to be at least in QuickBooks Premier. So what you get with QuickBooks Premier that you don't get with Pro or QuickBooks Online is you get sales orders, which to me are incredibly crucial, especially for setting up sales that haven't been delivered yet or shipped yet. Ability to create a PO from an estimate or a sales order. Okay, so that's extremely big because you do a sales order and you do an estimate, and you want to create the vendor PO straight from it. That to me is a huge time saver. The current availability window, which is about measuring what's available, including what's out in sales order. Max reorder point, which is the other sort of the cousin of minimum reorder, which allows you to kind of have an idea of how many you want to have when you actually replenish. Multiple units of measure are huge and extremely necessary for inventory assemblies and things like that. You also get item level price levels, right, which is extremely useful. So to have a particular customer that has an entire different price list. We have inventory assemblies, which is for bill of materials and manufacturers. Okay, and we have inventory center that is huge too. And I can't cover all these in one webinar, but again, if there's enough interest, we'll cover some of these. And sales order fulfillment worksheet. So this is the reason why I tend to recommend QuickBooks Premier as the baseline for QuickBooks inventory. Okay, the next topic here is inventory features in QuickBooks Enterprise. So now when we move beyond Pro and Premier, what does Enterprise do? Enterprise gives you 10 custom fields in the item level. And not only that, you can also hit a drop down. So you can actually create pre-filled drop down menus on your custom fields, which to me is great for in QuickBooks inventory. And in any sort of inventory function where the user can type anything they want in the custom field. Find and search items. So when you have a big item list, it's really useful to have a place where you can just search. automatically purchase. So you can actually automatically create a PO based on minimum and maximum reorder points. You have the option of completely separating two separate accounting transactions between item receipt and bill. By the way, in Pro and Premier, an item receipt and a bill is actually the same transaction. It's just done in two steps. Whereas with an enhanced inventory receiving, you can completely split it as if it was two completely separate transactions. This allowed negative quantities. This was added in QuickBooks Enterprise 2015. What a huge feature. I can't believe it took him 25 years to add this. This is actually blocks the user from being able to do any negative inventory. So this is already having a huge impact in a lot of my clients. Being able to add an item in the inventory center. So you can't really add the item in the sales order or in the estimate, but you can have it in the inventory center. So if you got widget A and widget B look exactly the same, they both look like widgets, you'll be able to see the picture and kind of see, okay, what the difference is. Updating the sales price based on a predetermined margin or markup, it's also huge. This is when you need to always make, let's say, 25% markup on a product and the vendors change the price, and we can have QuickBooks automatically change the list price as well. There's an awesome feature for manufacturers called where used. Basically, when there's a component change where you're replacing a component A with component B in all your manufacturing processes, you can do a one-click to do that. And then a shortage report on pending assemblies is also added in QuickBooks 2015. That was actually really, really, really good. The last one I'll talk about is QuickBooks Enterprise Platinum, right, which used to be called Advanced Inventory and Advanced Pricing. It gives you even more features. It gives you a FIFO inventory valuation, which I mentioned earlier. It's already in QuickBooks Online. It gives you barcode capability for selling and receiving. And by the way, it's still very weak. I like to call advanced inventory more like intermediate inventory because the barcodes are extremely thin, in my opinion. Multiple inventory locations, you get multiple bin locations, you get your choice of serial numbers or lot numbers, and lot numbers are very useful for expiration dates. We had a long conversation in yesterday's non-meeting about expiration dates, and advanced pricing, which is a sophisticated pricing method based on multiple conditions. So I think, and again, this handout is going to be given to you. I think it's extremely important that you know all these features, or even print this out and have it with you when you do any inventory consulting, because choosing the right product, it's one of the single most crucial thing to be able to design any sort of consultation. Anyway, so yeah, the previous bookkeeper is typically one of the culprits, but I think the biggest issue is some people are living in this bliss, right, where they don't even know their inventory is a mess, and it's our job to kind of jump in there and explain it to them, and again get really involved, right, and that sort of thing. Okay, all right, so let's talk about average cost now. Now, I made a statement earlier that I think FIFO is better than average cost, and rectifying myself, FIFO for the most part is easier to understand than average cost, and I'm gonna show you an example as of why, and I think once you kind of see that example, you understand why average cost, it's not as simple as you think it may be. So let me put the slide up, and then I'm gonna do sort of a mind exercise here, and I'm gonna tell you this particular situation. So we purchased 1,000 units of whatever, right, for $1 each on June 1st. And then on July 1st, I bought 1,000 units of that same issue for $2 each. Okay. So my question is, and just put this, I didn't put a polling question on this one, I should have, but just put it kind of on the chat, on the questions box. My question is, if I create an invoice in QuickBooks, what is going to be the average cost reflected in there? So what do you think the right answer is? And whoops, there it is. I think I had the results still shared. So we bought 1,000 units at $1 each, 1,000 units at $2 each in two different dates, right? And the question is, what is going to be the average cost on the next invoice I create? What is the right answer? Okay, and just in your chat, put the answer in there. And I'll tell you, most people are answering so far, they're answering C, 1.5 per unit. And the right answer actually is E. Okay, average cost is actually 100% dependent on the date that I sold it. And then subsequent to that, also D, because it's also dependent on the date that I sold it and the quantity that I sold. Average cost is very much date driven. And I'm going to show you the example, and it's going to make tons of sense once you actually see the live example. So I'm going to jump into QuickBooks Desktop here. And I guess somebody on the chat tell me if they can see a bill screen, if you see QuickBooks Desktop on the bill screen. Okay, so it looks like you do. Perfect. Okay, so I want to start by receiving some socks. So I'm going to basically buy some socks here, some socks, and I'll buy 1,000 socks at $1 each. And this was dated on June 1st. Okay, so that's the first example. So 1,000 socks for $1 each on June 1st. And I'm going to hit save here, and then go ahead and duplicate this bill. And this one's going to be on July 1st, and it's going to be the same 1,000 units for $2 each, and I hit save and close. Okay, so when I go into let's go into my inventory valuation report. So I'm going to go to reports, inventory valuation summary. What is my average cost right now? What is my average cost of my socks? Let me make this a little bit bigger here. My average cost is $1.50. Make the font bigger. Okay, it's $1.50. However, this is my average cost as of July 9th. My average cost on June 30th is $1. Okay, very much date driven. Okay, so let's just show you the example in a profit and loss report. I think it's going to make the most sense. So let me pull up P&L. And by the way, when I do training for my clients, especially if I want to demonstrate how cash basis work, or how something like this will work, I usually just show a P&L like this of both months. Okay, and let me make this font bigger. That way you can kind of see live, what's going on here. Okay, so I'm gonna go ahead and create an invoice. So I'm gonna go to customers, create invoice, and I'm gonna sell to my one customer here. I'm gonna sell them 100 units of those socks, and I'm gonna date this July 2nd. And I'll hit save and close, and my average cost is $1.50. Okay, that's that was 2 plus 1 divided by 2, $1.50. However, if that invoice shows up, I just show you this. If that invoice actually shows up not in July, but in June, because if you remember, I had bought the other units, the second batch of units for $2 each. I had bought that for $2. I hit save and close. My average cost is now, and let me hit refresh here, my average cost is now $1. Okay, so that proves to you that average cost is based on dates. So now the next question is, and I'll ask you to put an answer here on the chat box, is if I create the same another invoice for 100 units, let's say 500 units on let's just call that, I'm going to create one more invoice for 900 units in July. What is going to be my new average cost? I'll do 1,000 units to make it very easy. So put in your chat box, what is the new average cost now? Okay, so somebody's saying $1.50. No, it's actually not, because the new average cost is 900 units that are left times $1 plus 2,000 units times $2. So now it's not going to be 1.50. It's probably going to be 1.4 something. So let me just show you that example. So I'm going to go ahead and create an invoice, and I'll date this invoice in July now. So I have this invoice in July, and I'll sell 100 units. And where is my socks? There it is. Okay, and then and I hit save and close. Notice that my new average costs are 1.5 something. So it's no longer 1.5 exactly. It's going to be 1.52 whatever, because what it does is it recalculates average cost each time. This is why some people prefer FIFO, because with FIFO, I know that those units would be $1, and when I'm done with exhausting those that are $1, then we go over to the ones that are $2. But what confuses the heck out of people is that average cost is being recalculated in real time. Okay, now let me show you something else that's going to just throw you off here. Now, what if I backdate an invoice? So I'm going to keep that invoice for July for 100 units that the current cost is 1.53. What if I backdate an invoice in June and I sell 900 units? Will my July average cost change, and will my financial statements change? So let me show you that. So let me repeat the example. and I'll have you do put something in the chat. If I create an invoice right now on June date, right before I purchase the second set for $2 for all 900 units in June, what is going to be my new average cost in July? Okay, so does anybody have here an answer? Put it here to the chat. Okay, some people are saying $1, some people are saying $2. So let me show you exactly what I mean. So I'm gonna go to customers and go to create invoice, and then I'm gonna date this invoice in June, and I'm gonna sell 900 units. So I'm gonna sell 900 units, and I'm gonna select here socks, and there's 900 units, and I'm gonna hit save and close. So notice what happens is when I finish selling all my units that are in June, my average cost in June now reset to $1. So instead of being whatever the other amount was, and and now my July average cost recalculated to $2. So it almost feels a little bit FIFO. But this is the thing. QuickBooks is constantly recalculating average cost. This is why it is so crucial that when you close the period, you put a closing date password on that thing. Because if somebody creates a transaction that affects an inventory item, you're going to retroactively go forward and recalculate everything. So it's very much date driven, right? And like somebody's commenting here, it's not period driven, is date driven. Exactly. So it has nothing to do with the period, it has to do with the dates. And if I move transactions around, my average cost changes. So I'll give you another example here. So I'm going to go ahead and move the same example. I'm going to move this invoice from June 30th to July 4th, and now we're going to see that our average cost is going to be moved around again. Okay, now take a look at that. So my average cost got now moved around again because it got recalculated. So for the month of June, right, when I had bought inventory and the only inventory I bought was $1, it did it for $1. For the month of July, it recalculated. To make things even more crazy here, I'm gonna take that bill that I received. Let me go here to vendors, and I may be going overboard with this, but let me go back and look at the bill for $2. There's the bill for $2. I'm going to change the date and put this sometime in May. So I'm going to take this rule back sometime in May, and we're going to see now what's going to happen is my average cost got recalculated again, and everything else got calculated to 1.5. Isn't that interesting? I found that just extremely entertaining to just when I was going through that example myself to just double check that I was presenting the right thing. But it's the one thing, it's just bothers me how average cost works. Now, by the way, this makes total logical sense, but it will take probably some time for you to practice it and think about it in order to really get it up and running. So that's average cost. Now, for now, write down your CPE keyword. Wow, this time has flown by. I may not be able to do everything I wanted to do, but if not, we'll have another episode on inventory. So write down the CPE keyword. The CPE keyword is Florida. So write that down because towards the end, I'm going to ask you for the CPE question. So please write down the CPE keyword. The CPE keyword is Florida. So I'm going to leave that up for another maybe a minute, and I'm going to go through the questions to see if anybody has a question here. Somebody says average cost is not stable enough for presenting reports to shareholders when they require accurate financial statement presentations. So for the person that said that, so average cost will work really well as long as you close your financials, you close your financials and you do a closing date password, and this allows somebody, because that's the whole key is having somebody make changes to a transaction before that date. As long as you put a closing date password, you shouldn't have an issue. Now somebody says, does FIFO recalculate cost if you backdate a sales invoice? Okay, yeah. So yes, QuickBooks will recalculate FIFO as well. So this live recalculation of average cost also happens with FIFO. It's a different method, but it's that. Let me see. I believe that I haven't used average cost for the 20 years or so. It doesn't make. So somebody says I've used average cost for 25 years, and at the end of the day, it doesn't make a much material difference. So they're satisfied with average cost. There we go. How often do you close financials? Somebody's asking me that. At least once a year. Yeah, for sure. At least once a year. Let me see. Somebody says that I look like the title of my name under my webcam says Michelle Long. Yeah, I had to log in as Michelle because Michelle is not available. So I'm sorry about that. Okay, so last time for the CP keyword, let me see, I don't think I can change my name on the webcam. No, no, I'm still going to be Michelle Long. Okay, all right. So let me go to the next slide here. And landed costs. Oh man, I don't have that much time to do landed costs or inventory troubleshooting, so I have to pick one. Okay, I'm gonna pick landed costs real quick, but I'm gonna refer you to a video that actually goes through the entire detail. So I'm gonna do really, really quick landed cost. So let me jump into QuickBooks here, and let me try to tell you what the issue at hand is, and let me just uh, delete this invoices and these bills. That way we don't have any confusion here. So I'm going to tell you about landed cost in a second. And I'm actually going to do a simplified version of landed cost because I have a YouTube video that has the detailed version of landed cost. And of course, because I won't have time to cover all that stuff there, yeah, I'll refer you to that video. And let me go into my bills here. I'm just trying to make sure that I don't have anything here to mess things up. Okay. All right. So there we go. So let's talk about landed cost. So let's say I'm gonna buy 1,000 socks and let's say and 3,000 shirts. Okay, so this is my bill from my manufacturer, right? And this is actually how much I'm gonna pay my vendor or my manufacturer for the product. However, there is a shipping cost. There is a shipping cost component that I have to pay, right? And that's typically seen in the it manifests itself as some other bill or some other payment to a shipping company. So there's my inventory receiving of whatever it is. This is my actual amount that I'm paying my vendor. And then I'm going to have a separate transaction, which could be a check, a wire transfer, whatever, for my freight. So I'm going to go ahead and pay, let's say, $4,200 in freight. And I'll put here expenses and I'll put freight. And this is typically what customers do, right? They'll take it to an expense account called freight. Okay, so I'm gonna hit save and close, and then I'm gonna show you the profit and loss. And this is the problem that we have. The problem that we have is that because freight was a separate transaction than the inventory receiving, it hits my profit and loss right away. The problem with that is if I sell this product, let's say in July, so let me just put here couple dates here so we can see what the P&L looks by month. So the issue is if I actually make a sale in July, my June looks overstated in expenses and my July is going to look understated in expenses when the actual average costs pull in. So let me show you what I mean by that. I'm going to go to customers, create invoice, and I'm going to go ahead and sell a couple of these units here. So I'm going to sell one and one just to kind of illustrate how this works. So I'm at one shirt and one sock. Okay, so I'm gonna hit save and close. So what happens is my cost of goods sold right now is the actual cost of the unit. So the cost of this unit, which in this case, let me show you exactly what that was. The cost of this of one unit was 6.27 for the shirt, and for the other unit was $2. But this is unfair, right? Because we actually had $4,200 in freight, and we need to make sure that that freight, and let me just move this sale to July. Sorry, I should have moved this to July to make it much more impactful on the profit and loss. So I'm going to move that here. So what ends up happening is it looks like June was a huge loss because I paid all this freight, and it looks like July is a profit. And by the way, that there's still a profit, but the profit should be a lot smaller. So right now my financial statement looks all out of whack because I sent freight costs straight into the expense account. So the trick I'm going to show you is the most simple method of doing average cost. What we're going to do is we're going to take this $4,200 here and we're going to distribute them evenly across all these products. So let me go into this bill here. So I'm going to go to enter bill and go back into this bill. And not this one, but that one. So what I'm going to do is I'm going to make a quick calculation here. So let me do a calculator, and then I'm going to say, okay, so I have $4,200, and I'm going to divide that by the number of units. Okay, so that's $3.23. So based on my calculation, I need to add $3.23 to each of these units. So I have to manually come in here and put add 3.23 and come in here and add 3.23. There's really no other way of doing this. This is how the only way you can do this in QuickBooks. But then when you come into expenses, you have to make sure that you're hitting back that freight cost. So basically what that 41.99 transaction does is it's going to reverse my freight cost. That way it will make it look like we never really had freight costs, and it's going to add the actual allotted or landed cost component into it. Now, the problem with doing it by quantity like this is that we're not considering things like, what's the weight of the product, or what's the volume of the product, or things are actually affecting my freight costs. So I'm going to put a link to my YouTube video where I actually tell you how to do it with all sorts of components. But in a nutshell, this is how you do it. And if I had more time, I would do it the whole thing on the live webinar, but I just don't. So what ends up happening now is, now if you take a look at this, now my cost of goods sold are shown correctly, and now it actually shows that I didn't make any money on the deal. So it was interesting. It looked like it was a profitable deal before, because when I was looking at my cost, I was not considering at my freight cost. So this is why inventory consulting is so important, because sometimes clients sell stuff under cost because they didn't calculate landed cost appropriately. Now I'm sure somebody's going to comment, well, Hector, there's still $1 left on that freight cost when you look, and yes, it's not going to be